Okay, so guys, a very good evening to all of you. Okay, so guys, I'll be starting with AFM, and in AFM, I'll be doing with these all these chapters. First of all, I'll introduce myself. My name is Sandeep, and so I'm a working professional. Last 15 years, I've been working, and I also teach simultaneously. Generally on weekends only. But so when are you guys planning your exam? Ishika, Aditya, Sarumati, when are you planning your exam?
I'm planning for December attempt.
Achha, December itself. Okay, and what about
Sir,
others?
in
Yeah.
December, sir.
Okay, and Ishika. Okay. So yeah, Ishika, you're from FinTram. Yeah. Okay. Okay. So guys, let's get started. I think we'll get started with the BVP. So we'll try to cover this from the BVP itself, right? And yeah, Ishika, can you make me the host? If you can see that if I can be the host, or uh, should I log out and log in again? Just guys, I'll just join again. Just give me 1 minute. Maybe I'll just join again. Okay. So I'll just share my screen and let's get started with the BVP module. So I generally, teach from the BVP module. So, we need to cover up these chapters, and I hope my screen is visible to all of you. Financial strategy formulation. Okay. So let's take the first chapter. In this, I'm going to discuss with you about financial objectives, financial strategy formulation, investment decision, financing decision, ethics, green finance. And then, financial objectives, if you see what is the financial objective of any organization, what is the primary objective is to maximize the profits. So investors care about the futures, they care about the dividend, they care about the risk, the financing plans of any organization. For a profit-making company, if I have to speak, so the objective of the company is to maximize the wealth of the shareholders. This can be measured as a total shareholders return. So what is the return they are expecting? So if you see generally, yeah. I'll see that if I can download this and give it to you guys. So just allow me some time. I'll see if I can download this. We'll do something about it. Samruti, just don't worry. I'll try and see and share it with you. You guys can share your email address with me and I'll try and circulate this to all of you. Okay, so total shareholders return, if you see how do you calculate the total shareholders return. So shareholders generally get returns on the basis of two things. So they will get it in terms of, first is the dividend growth and the second one is the capital growth. So capital gains or losses. So many companies have non-financial objectives that also will be important in assisting a company to achieve its strategic goals. For example, a manufacturing company that is aiming to differentiate itself on quality will require targets for defect rates. So this does not negate the importance of financial objectives, but emphasizes the need for companies to have other targets than maximizing of the wealth. So of course, if you see, there is importance of financial targets, but apart from financial targets, there are other targets also. Say for example, one of the biggest target is maximization of the shareholders' wealth. So a financial strategy formulation of financial strategy should comprise an organization resources to maximize the return to the shareholders by focusing on future cash flow, financing, and risk. Maximize the shareholders' wealth. How do you maximize your shareholders' wealth? By maximizing the investment decision, financing decision, and dividend decision. So basically, you need to maximize the shareholders' wealth. Uh, by taking proper investment. So, you should know where you should invest the shareholders' money and then where the money will come from, and then finally how much dividend you have to pay. So whether you should pay dividend or you should not pay dividend is all of that, and then all these three are categorized as risk management. So if you see, investment decisions are seen as a key mechanism for creating the shareholders wealth, but they will also need to be carefully analyzed to ensure that they are likely to be beneficial to the investor, right? So the technique for analyzing investment decisions are covered. So investment decisions, so we'll be covering a great bit of detail about investment decisions in chapter number 3 and 10. Financing decision. So use of debt financing. One of the main aspect of financing decision is how much of the debt should a company use, right? Because debt is risky. Debt is not advisable. So how much of the debt should a company use? Because of course, debt is a cheaper source of finance, but it is risky also because you have to make those payments, right? So it is considered to be risky as well. So the level of gearing that is appropriate for a business depends on the practical issues, life cycle. So a new growing business that will find itself difficult to forecast cash flow with any certainty. So there are high levels of gearing are unwise. Now, if you see, if there is a new business, now, for a new business, generally, there will be no cash flows, there will be limited sales. So, high level of debt is something that is not advisable. Okay. Now, if you see operating gearing, if the fixed costs are a high proportion of the total cost, then the cash flows will be volatile. So, high gearing is not sensible. Now, if you have a lot of high fixed cost also in the company, then don't go for high level of debt, right? So, because if you have both operating gearing as well as financial gearing, then the business will become very risky. So there are generally two types of fixed cost. One is the operating fixed cost and one is the financing fixed cost. Now, what do you mean by operating fixed cost? Is the fixed cost of salaries, rent, warehouse rent and all of that. So, and the next one is called as the financing gearing, which is called as like the interest you pay on the debt. So if you have very high business risk, then business leverage, business fixed cost, then don't go for high financial interest cost and all of that, so that otherwise your organization will become very very risky. So if you are operating in a dynamic business environment, then cash flows will be volatile. So high gearing is not sensible. If unable to offer security, debt will be difficult and expensive to obtain. Okay, so that is what it is. I hope this is clear. So stability of revenue again is very much required. Otherwise, you can't go for gearing. If you are unable to offer any kind of security, then debt will be difficult to obtain. Because if you go to a bank, they will always ask you for a security. In order to survive, any business must have adequate net cash inflow. Businesses should try to plan for positive net cash flows, but at the same time, it is unwise to hold too much cash. So the important question that arises is that how much cash do the business hold, right? In the case if the business is holding too much of a cash, that is also not considered to be good, because ultimately you should return the cash to the shareholders, because ultimately the cash belongs to the shareholders, so you should return it to them. So when a company is cash rich, the senior financial advisor will have to decide whether or not to do. How to use the cash, and then if you see payout of cash to the shareholders in form of dividend, or we should buy back the shares, etc., etc. What should we do? So where cash flows have become a problem, a company may choose to sell some of its assets. Now, sometimes what happens is that in the case if you don't have cash flows, right? So then you may have to sell off your assets. However, it is important to recognize the difference between assets that a company can survive without and those that are essential for the company's continued operations. So, difference between assets that a company can survive without and those which are essential for the company's continued operation. So, what are the assets that we can continue to survive without? And what are those which are essential for the company's operation? So assets can be divided into three categories: those that are needed to carry out the core objectives of the business, those that are needed for carrying out the main activities of the business and can be sold off at a fairly short notice. So basically those which are plant property and machinery, those which can be sold off at a short notice, and those that are not essential for carrying on the main businesses and can be sold off to raise cash but may take some time to sell. For example, long-term investment subsidiary companies. So basically, you have got plant property equipment, you have got short-term marketable investments, and then you have got, if you are making any investment in a subsidiary and things like that. Okay. So this is what it is. Yeah, go ahead. You're saying something? Anybody? Yeah. Anybody is saying something? Any questions? Okay. So, guys, I'll just pause here for a minute. Since you guys don't have any book, I'll just go to the previous page, and I will just give you some time, let's say for 2-3 minutes, just read whatever we have discussed, Aditya and Samruti. So just read what we have discussed and let me know if you have not understood any point or you want me to revise any of the points. So we are discussing on the chapter number 1, uh, which is financial strategy formulation. Okay, so we'll go and complete all these chapters, but we are on the chapter number 1, which is financial strategy formulation. Okay, so I'm just pausing on this page. You can read it and then I will move forward. Okay, so guys, I hope you have read this, and if you have any doubts, just let me know. Risk management decision. So risk management in AFM mainly involves management of exchange rate, interest rate, project management issues. Again, the volatility of an organization cash flows are powerful influence on its approach to risk management. So the more volatile the cash flows are, the more important the risk management becomes. So you can see that the more volatile the cash flows are, the more important the risk management is. Risk management will again be discussed in the subsequent chapters. Now, that is about risk management, which also plays a very important role for you guys as a AFM or a ACCA. So, the dividend decision is related to how much a firm may decide to spend on investments, also on how much of the finance needed for investment is being raised externally. Finance decision, this is illustrating the interrelationship between the key decisions. So basically, how much they should invest and then how much they should give in terms of dividends. So if a company is growing, then much of the cash it has will be better used to invest in positive NPV projects. So it will not have liquidity to pay the dividends. Now, in the case if it is a growing company, then most of the money is used to invest in projects. So shareholders expectation will often be low or zero dividends in case if it is a growing company. However, if the company can borrow to finance the investment, it can still pay some dividends. So there are legal constraints over the company's ability to do so. If it is only legal if a company has accumulated realized profits. So how much dividend can a company give? So there are legal constraints over a company's ability to do so. If it is only legal if a company has accumulated, so can a company pay dividend? Sometimes there are legal restrictions also. Dividend policy also changes during the company's life cycle. So if you see when the company is young, generally they'll pay a low dividend. When the company is matured, they'll pay higher dividends. Why they will pay higher dividends? Because the company can take more debt, so they can pay more dividend. Here they will not be able to get debt, so how will they pay dividends? So whatever cash they have, they will use it in terms of their own business, right? Business growth. So dividend investment and financing issues will impact an organization capacity to pay dividend. Dividend capacity cash generated in any given year that is available to be paid to the ordinary shareholders. So how do you calculate dividend capacity, guys? And the answer is given here. If you see profit after tax, after interest, after preference dividend, less debt repayment, share repurchases, investment in asset, add back depreciation, and any capital raised from new issue or debt. So just remember this formula. This formula will give you the dividend capacity that is there. And using this formula, I will request you if you can click a photograph of this activity number 1, and then please start solving the activity number 1. Just click a photograph of this. So I'll request you to first of all click a photograph for this, which is a dividend capacity. You can take a photo of this, and then for the activity number 1, and I will request all of you to start solving with the activity number 1. So you can click a photograph of this, Aditya. So what is the formula to calculate what is the dividend capacity? Now, what is the dividend capacity telling us what is the cash capacity with the company to pay dividend? How much is the cash available with the company to pay dividend? How much dividend they can pay? Okay, so just note down this and then let me know. Have you clicked the photo for this one, guys? Okay, so you can click a photo for this activity number 1 also. Okay, done. Now you can start solving for this particular question. So Aditya and Samruddhi, I'm giving you 5 minutes. You can take your time and try to solve this particular question. Okay, so guys, I'll share the answer for this one. Okay, is this clear? All of you, is this clear? Have you understood this, all of you? Okay, so just have a look at this. I'll just pause for a minute here. Okay, guys, done? Understood, everyone? Yeah, so guys, if you see, why are we not considering depreciation is arriving at profit after interest and tax? So basically, profit after interest and tax is already after deducting depreciation. Na? Does that right? So it answers your question. So now, what is the next question? This looks something similar to cash flow statement wherein we add back. Yes, we add back depreciation because it is net off, na? No, PAIT does not contain depreciation. It is net of depreciation.
Hello, am I audible?
Yes, you are.
Yeah, so basically what I'm trying to ask is how did we calculate profit after interest and tax? Because look, the only way I'm looking at this, the way you have calculated is that you have removed the
Now have a
depreciation,
look at this. 400 minus 30
which is
minus
finance charges,
75.
and 75 is tax. So you have not reduced depreciation over here, but profit after interest and tax should have depreciation removed, no? That is why we are adding it back, because then we add back non-cash items to arrive at our dividend capacity.
Yes, yes.
So and then this asset calculation is also confusing because it says book value, not carrying value. So you don't actually have to remove depreciation for current year either. So if you adjust that thing down there and adjust profit after tax, will arrive at the same answer, but the method will be significantly different, no?
Yes. So if you see, so what is happening in this case is operating profit is EBIT, earnings before interest and tax, right? Operating profit is earning before interest and tax, EBIT, which means that it is already net of depreciation, na, my friend. This is EBIT. So, which is 400 minus T minus I. Correct? Now it is clear, Aditya?
Okay.
And then I add back depreciation.
Okay.
Now is it okay? Logical?
Yeah, but then capital expenditure again, book value is equal to carrying value, or is it supposed to be
No,
historical?
capital expenditure, whatever they are doing, I think it is given to you in the question. Correct? So just give me 1 minute. Yeah, so we have calculated it here. Just give me 1 minute. So see, I'll tell you what is the formula on the basis of which you can calculate is opening non-current assets minus depreciation for current year plus additions is equal to closing non-current assets. Do you agree with this formula?
Yeah, sure.
So basically the opening value, which is the last year, means the opening value only, minus depreciation. You don't know. So, no, depreciation is given to you in the question. So depreciation for the current year is 60. Additions you don't know. Let us assume X. Closing you know it will be 40 higher. So 240. Now can you solve for X? What is X? 100? Answer.
Yeah, so I was confused with the terminology there because book value is a term that I did not understand. So book value means carrying value.
Yes.
Okay,
Now clear?
sure.
Okay. What about Sarumati? Is it clear to you also? Sarumati, is it clear to you? Yeah, I'm showing you the question. You can click a photograph of this. I'll try and send you the book today itself so that you guys have the book available with you. Just give me 1 minute. I'll share my book. Just give me 1 minute. Yeah. Now you can click a photograph of this so that you remember.
Sir, next page, sir. Show me the next page, sir.
Is it clear now?
Yes, sir.
Okay. Now, dividend policies, if you see, it can be a logical but can create volatile dividend payment if profits are volatile. Stable growth, set at a level that signals the growth prospects of the company but may be difficult to maintain if circumstances change. So stable growth, residual policy is after paying all the NPV project, whatever is left is the residual. So constant payout. So it is like if you are earning 50 rupees, then let's say 50% you will pay. So that's like a constant payout of the earnings. Stable growth or residual after paying all the NPV projects, whatever is left is paid. So a company will sometimes offer a scrip dividend instead of cash. Compared to a cash dividend, a scrip dividend boosts a company's cash flow and may benefit the shareholders if cash is reinvested in NPV projects. Now, sometimes what the company will do is that they will give them extra shares. So the company will not give them cash dividend, but they will give them extra shares. So that is also beneficial, right? Why it is good? Because shareholders will get shares and the company will conserve the cash. If the company is conserving the cash, the company can reinvest the cash in the NPV, which is positive NPV projects. So an enhanced scrip dividend involves giving shareholders a choice over whether to take cash or shares, but offering a generous amount of shares so that it is likely that the shareholders will choose take the shares instead of cash. So giving them shares instead of cash, correct? Offering a generous amount of shares so that it is likely that shareholders will choose to take shares instead of cash. So that's another important thing. Share buyback, an alternative to cash dividend is to buy back the shares to return the significant amount of cash to the shareholders by the means of share buyback. Okay, so advantages of buyback, if you see is avoids the increasing expectation of higher dividend because you are buying back the shares. Provides dissatisfied shareholders with an exit route. It is a defense against the takeover. And so you give an exit route to your shareholder. Tax as capital gain, which may be advantageous if the tax on capital gain is below the rate which is used to tax dividend income. Sometimes the tax on capital gain may be advantageous than the tax on dividend income. So if shares are undervalued, what can happen is that the company may be able to buy back shares at a lower price, which will benefit the remaining shareholders. If the shares are undervalued, the company can buy back the shares at a lower price, which will benefit the remaining shareholders. Fewer shares will improve the earning per share as well as dividend per share. Right, so company can buy back the shares. Of course, in the case you buy back, you don't pay cash. That cash can be invested by the company in positive NPV projects. Provides dissatisfied shareholders with an exit route. Taxed as a capital gain. Tax on capital gain may be lower. than that on the dividend income. Special dividend, another way of returning significant amount of cash is by way of a special dividend. Now, special dividend is a one-off dividend, cash payment in excess of the normal dividend. So this has a similar effect of returning significant amount of cash, but generally they don't have expectation that again it will be paid in the future. It means advantages for the shareholders. Just give me 1 minute. Yes, so advantageous means that there is lower tax. Yes, for the shareholders. Okay, clear? So that's okay. Now, if you see that is special dividend, so this has a similar effect of returning the significant amount of cash. A special dividend is more attractive than a share buyback if shares are overvalued, and avoids shareholders potentially diluting their control by participating in the share buyback. Okay, so guys, I hope this is clear and all of you have understood. Any doubts on this one? Any doubts? Okay, so you know what I will do is I'll pause here for today since it is our first class. So I will just try and arrange the book for you, and then in this sequence only, more or less, I will be moving. Okay. So also one more thing that I wanted to share with you is that you know, this week I am a little tied up, so we'll see. But you know, I am on off from the Dashera week, so I have this week off. So both of you are working, or you guys are studying. So what about you, Aditya and Sarumati? What about you? You guys are working, or you have time, flexible time, or okay, Aditya, you're not working. Very good. Sarumati, you are working. So what is your time, Sarumati? When are you available? So is it like a very fixed, demanding job, or you can be flexible? Oh, from 7 you are available. Okay, so 1 or the 2 days of the Dashera break, I'll see that you know we keep some extra sessions there. So I will let you know. I'll keep a schedule. So maybe 1 or 2 days, Sarumati, just see if you can adjust. Okay, if you can take a off or something so that we can cover up a portion, right? Or if you can go a bit late because Aditya is available, so Aditya does not have any problem of time, so he can manage, right? Just see that if you can manage the time, that will be great. Okay, so let me just have both of you send me your email addresses. I think I've got it from Aditya. I have got yours, and yeah, Sarumati, can you send me your email address also? Yeah, just let me see that, you know, if I can. Yeah, so Sarumati, I'll try and give it to you as soon as possible. Okay. Okay, guys, so I will just try and send you the book. Both of you have received your email address. And in the next class, I'll start with section 3. Just remind me that I have to start with section 3, which is ESG. But first of all, let me try and send you the book. Okay, both of you? Aditya and Samruddhi, is it okay? So we'll start in the next class. And because today is just the first session, so in the next class, we'll do section 3, which is ESG. And so we'll see that, you know, we cover the entire book. Don't worry. Okay. So thank you so much, guys. Have a good day and look forward to see you in the next class. Thank you.